Welcome back to the Wall Street Podcast. Today we're doing a deep dive into a brand new research report from Goldman Sachs. It's on Apple Inc., ticker AAPL, of course.
That's right. It's their F3Q25 first take. Came out just yesterday, July 31st, 2025, late afternoon, around 5:07 p.m. Eastern.
And it's their initial analysis, their first look at Apple's fiscal third quarter results for 2025. So our job today, let's unpack these results. Did Apple really beat expectations by that much? And what does this report suggest about their resilience going forward?
Exactly, because the report, it shows some big wins. Revenue, margins, pretty strong beats across the board.
Yeah.
But importantly, it also highlights some forward-looking points, some risks that you really need to consider beyond just those headline numbers.
Okay, let's jump right in then. The F3Q25 highlights. First up, earnings per share came in at $1.57.
$1.57. Yeah, a very clear beat. Goldman themselves were expecting $1.45, and the consensus was even lower at $1.43.
So a significant beat there. What about the top line, the revenue?
Also quite strong. Total revenue hit $94.0 billion.
$94 billion, wow.
Yeah, comfortably ahead of Goldman's 89.5 and the consensus 89.4 billion. And that's 10% growth year over year.
Okay, let's break that down a bit. Product revenue.
Products reached $66.6 billion. That also beat estimates, up 8% compared to last year.
And services. I heard that was a particular bright spot.
It really was. Services revenue accelerated, growing 13% year over year. It hit $27.4 billion, another solid beat against forecasts.
That acceleration is key.
Absolutely. And this strong performance wasn't just on the top line. It flowed through to margins, too. Product gross margins were 34.5%. Better than Goldman predicted, better than consensus, too.
And services margins.
Even more impressive, really. 75.6%, just slightly above estimates. But that figure marks the second highest services gross margin they've ever recorded.
75.6%, that's incredible profitability.
It underscores just how valuable that side of the business is.
Okay, so clearly strong numbers overall. Let's talk drivers. What was behind that product revenue strength specifically? What did Goldman pinpoint?
Well, the report really attributes it mainly to iPhone and Mac. Both performed better than expected. And interestingly, CEO Tim Cook mentioned something specific, a demand pull-in.
A pull-in, what does that mean exactly?
It means some demand, roughly 1 percentage point of revenue, or about $900 million, likely happened earlier than expected. The thinking is it was probably driven by customers buying ahead of potential or announced tariffs, so that gave the quarter an extra boost.
Okay. That makes sense. A bit of timing shift there. But you mentioned iPhone and Mac did well. The report also notes that iPad and wearables, home, and accessories actually missed estimates.
That's correct. They did come in below expectations.
So does Goldman see this as a worry? Or just, minor variations within a strong quarter?
The report doesn't seem overly concerned. It focuses more on the overall positive picture driven by iPhone and Mac. But it does suggest, perhaps, that growth isn't uniform across all product lines. Maybe some consumer spending shifts or just tougher competition in those specific areas, like wearables or tablets.
Right. Something to keep an eye on, perhaps. Now let's pivot back to services. We saw accelerated growth, near record margins. What does this really signal for Apple's bigger picture? Their profitability, their whole business model?
It's hugely significant. That 13% year-over-year growth combined with, as you said, those incredible 75.6% gross margins, that demonstrates really strong operating leverage.
Meaning profits grow faster than revenue.
Exactly.
Yeah.
As services revenue climbs, the costs associated with it don't climb nearly as fast. So profitability ramps up significantly. It really cements services as this critical recurring revenue engine. It adds stability, buffers against hardware cycles, and frankly makes the whole Apple ecosystem stickier and more valuable.
That integrated ecosystem seems to be the recurring theme here.
It definitely is.
But looking beyond these results, no company is without risks. What does Goldman flag as potential headwinds or things to watch out for?
Yeah, they definitely outline risks. First off, Goldman maintains their buy rating, and they have a 251 red price target. They seem to think the market still undervalues that ecosystem strength.
Okay, but the risks.
Right. Key risks include sort of the macro picture weakening consumer demand overall. And specifically for Apple, maybe iPhone replacement cycles getting longer. Then there's the supply chain, always a factor. Tariffs, the dependence on China for manufacturing, those remain concerns.
Or petition.
Intense competition, yes, across all their segments, phones, computers, services, everything. Plus, regulatory risks are a big one. Things like App Store policies impacting their proprietary product.
And capital allocation.
Yes. How they manage M&A and share buybacks is also listed as something to watch. Essentially, execution risk there. And Goldman expects more color from Apple soon on Q4 demand, how they're diversifying the supply chain, handling China competition, and, crucially, their AI strategy. That's becoming increasingly important.
Okay, so it's a complex picture. On one side, you've got this incredibly robust ecosystem, especially with services powering recurring revenue and high margins. That's the core strength.
A very strong foundation.
But on the other side, Goldman lays out this pretty significant list of risks: consumer weakness, supply chain, competition, regulation.
Which really brings us to the key question for anyone watching Apple. Considering these headwinds alongside that undeniable core strength, how does Apple sustain its premium valuation? How do they keep driving growth in the coming quarters, especially with the tech landscape and the global economy constantly shifting?